A very good evening to you, ladies and gentlemen. I am happy to welcome you to the 15th webinar of Series 6 on Basics of Law titled Law of Taxation. This is the 46th BSL webinar for the years 2025-2026. This webinar series is organized by the Webinars and Legal Symposiums Committee of the Bar Association of Sri Lanka. I would like to take this opportunity to thank the chairman of the Webinars and Legal Symposiums Committee and the president of BSL, Mr. Rajiv Amarasuriya, the co-chairman, Mr. Chatre Galhena, secretary of BSL, and Mr. Pasandu Silva, treasurer of BSL, and the conveners, co-conveners, and the members of the Webinars and Legal Symposiums Committee. I would also like to extend my heartfelt gratitude to the executive committee of the BSL for all the support and guidance. For today's webinar of Law of Taxation, we have with us an esteemed panelist, Mr. Manohara Jayasinghe. Mr. Jayasinghe is a Deputy Solicitor General of the Attorney General's Department. He holds a Bachelor of Civil Law from Oxford University and a Master of Laws from Cambridge University. Mr. Jayasinghe is also the lecturer in Administrative Law at the Sri Lanka Law College. I warmly welcome Deputy Solicitor General Mr. Manohara Jayasinghe for today's session.
Thank you, Ishwari. Thank you.
Thank you, sir. To moderate today's session, we have with us Mr. Rushita Rodrigo. Mr. Rodrigo is an attorney at law of the Supreme Court of Sri Lanka and holds a LLB honours from University of London and LLM from University of Colombo. He is practicing commercial law, public administrative law, company law, tax and customs law. He is also the visiting law lecturer at the Institute of Chartered Accountants, Sri Lanka. I also warmly welcome Mr. Rushita Rodrigo, attorney at law, for today's session. And without any further ado, I invite him to commence today's proceedings. Over to you.
Thank you, Ishwari, for that introduction. Today's topic is law of taxation. Law of taxation, as many of you would be aware, is not only a vast area, but also a complicated area of law. However, despite the time limitations that we have been given today, during today's webinar, we aim to simplify this area of law to enable our viewers to understand some of the basics of the law of taxation within the time period allocated for us. I now call upon our panelist for today, Mr. Manohara Jayasinghe, DSC, to firstly briefly explain to our viewers as to the history of taxes, the type of taxes that a person is obliged to pay, and why are taxes so important from the perspective of a government. Over to you, Mr. Jayasinghe.
Now, Roshita, when Mr. Rajiv Amarasuriya invited me to do this webinar on the basics of law, I wanted to do something that was very meaningful and impactful and relevant to everybody. So then I remembered this statement by the great American politician and scientist Benjamin Franklin. There are only two things certain in life: death and taxes. So on a Friday evening, I don't think we want to be talking about death. So I think we should just talk about taxes. Now, if you think about taxes, well, sorry, before I elaborate upon the actual topic, I wanted to thank Isuri for her very kindly introduction, but I want to add something to it, as in introducing myself. I think when you introduce yourself, it is important to tell people who you are, but it is also important to tell people what you're not. So I need to be very clear. I'm not a tax consultant or a tax advisor or a tax expert. I'm not even a tax lawyer. I'm just a regular lawyer, but I have appeared, I think it's fair to say, in a large volume of tax cases in the Court of Appeal. And I think to that extent, I think I do have the capability of expounding some of the basic principles of tax law and how those principles are applied and interpreted in our courts of law. And that is what I'm planning to do today. So, Rushita, on your question as to what type of taxes that the government levies. So, broadly speaking, there are two types of taxes. the government might tax you on the money that you earn, and the government might tax you on the money that you spend. So the taxes that are charged on the money that you earn is what we commonly call income tax, and that is covered by a legal regime called the Inland Revenue Act of 2017. As far as the taxation on the money that you spend, that is what we commonly call a sales tax, and the current legal regime relevant to a sales tax is what you call the value added tax of 2002. So the question as to why taxes are so important, as I think it was Margaret Thatcher who once explained that the government doesn't have any money of its own. The money that the government has is your money, as in our money. So if the government is expected to discharge and dispense the multitude of services it is expected to, it needs to have a source of revenue. And this is what is sought to be achieved through taxation. Also, taxes can have an alternative function. Taxes can also act as a deterrent to certain kinds of practices or behaviors which the state in its policy thinks it's somewhat inimical to the welfare of society. So for example, the government can charge a very heavy tax on motor vehicles that consume a high volume of gasoline, or it can pose very heavy taxes, and in fact it does this on certain deleterious or hazardous substances like cigarettes and alcohol. So these are some of the rationale associated with taxation.
Thank you, Mr. Jaisingh, for that brief explanation on taxes. I would like to, in your introduction, you spoke about two aspects. Firstly, you mentioned that money you earn is tax, and secondly, you also mentioned that money you spend is tax. So, firstly, I would like to draw your focus to money you earn. One of the questions that many have is the entirety of the money you earn taxable, or is it a portion that is taxable, or how is it calculated, and how is it calculated?
Right, that's a very good question, Roshita, because I think one of the things a lot of the people interested in tax law would be interested in knowing is what is the scope of taxation. So for the purpose of clarity, I will focus primarily on the income tax law, which is the Inland Revenue Act. If time permits, I'll make a very brief reference to the value added tax regime. But on the income tax law, one of the things I think if you consider income tax in general, what we need to do is identify three questions. And I'll articulate those three questions, Rushita. First is, who is liable to pay income tax? The second question, on what do you have to pay income tax? Thirdly, how do you calculate income tax? Who is liable to pay income tax? On what do you pay income tax? And how do you calculate that income tax? So just one quick caveat, Roshita, the currently operational legal regime is the 2017 Inland Revenue Act, but most of the cases that we do in court arises from the now abolished 2006 Inland Revenue Act. But sometimes I will be using terminology from the 2006 Act, but that doesn't make a difference because the lot of the basic principles are quite similar. So on this question, who is liable to pay income tax? Now, the answer to that question is simply everybody. everybody is liable to pay income tax. Now, specifically, income tax liability is imposed on two categories of persons: residents and non-residents. So what do you mean by residents? What do you mean by, and why do we even have this distinction between residents and non-residents? A resident is defined as a person who lives in Sri Lanka for 180 days or more. A non-resident is a person who lives in Sri Lanka for less than 180 days. What is the consequence of this distinction, you may ask? So the consequence of this distinction is, if you are a resident of Sri Lanka, you have to pay income tax on all your sources of income wherever arising. So for example, if I take myself as an example, I would have to pay income tax on my salary. If I have stocks or shares, and if I'm paid dividends, I have to pay income tax on those dividends. If I have a fixed deposit, I have to pay income tax on the interest income. And you'll be quite surprised to know, if I'm a resident of Sri Lanka, even if I have a source of income in England, I have to pay income tax on that as well. Now that might strike many of you as being very strange and unfair. And some, because apart from paying income tax in England to Her Majesty's revenue, do I also have to pay income tax in Sri Lanka also? No, that hardship is sometimes ameliorated by what are called double taxation treaties. So, where a double taxation treaty applies, you may not have to pay the full scope of taxes. In the case of a non-resident, that is a person who doesn't live in Sri Lanka for a period of 180 days or more, now that person will have to pay income tax only on an income source in Sri Lanka. So for example, the example that I'd like to give is, if some musician comes to Sri Lanka and does a concert performance and he's paid a very, very heavy fee, he has to pay income tax on that sum of money. Now, you might argue, why do I have to pay income tax to the government of Sri Lanka? I'm not a citizen of Sri Lanka. I'm not a resident of Sri Lanka. No. The reason why we have a provision like this is because even that musician who comes to Sri Lanka, he's using the resources and the infrastructure of Sri Lanka in order to earn money, and it is on that premise or on that principle that he or she is also required to pay income. So on this first question that I posed with respect to what is the scope of income tax, and on this question as to who is liable to pay income tax, the distinction is drawn between residents and non-residents, and residents have to pay income tax on their income wherever it arises. Non-residents only have to pay income tax on a source of income that is in Sri Lanka itself. Rushida, do you mind if I proceed to the next part of your
Yes, yes,
analysis? I think you were
yes.
asking. So one of the questions I think that interests most people is, on what do you pay on what do you pay income tax on? So I'll take a few minutes, if you don't mind, Rushit, to explain this. Let's say I have multiple sources of income. I might have a government salary. I may have dividends from my shares. I may get a interest income from my fixed deposit. So when I put all of these money together, basically the entirety of whatever I earn, that is what we call the total statutory income. Now, to answer your question very clearly on what do you have to pay income tax, you don't have to pay income tax on the entirety of that income. This is because you're entitled to what are called deductions. Deductions for expenses and losses that are incurred in the course of that income generating activity. So let's say I have a bakery. So the total income that I make from that bakery, assuming I have no other source of income, that is what I would call my total statutory income. Now, I don't calculate my income tax on the total statutory income. So what I do, Roshita, is I take the total statutory income and I deduct from the total statutory income all of my expenses, or to be more accurate, the permissible deductions. I'm not allowed to deduct certain types of expenses, but that's a little intricate. I don't want to go there. But all of the permitted deductions, once I deduct all the permitted deductions, I arrive at a figure or a value called my assessable income. So for my total statutory income, I make deductions for my expenses and losses, and I arrive at what is called my assessable income. Now, I don't pay taxes even on my assessable income. Then what? I take that assessable income, and then, just to give you an example, somewhat simplified so that our attendees understand this better, sometimes people give money to charities, and rich people are very smart. They tend to give charity to what are called tax deductible charity organizations. And our Inland Revenue Act lists a multiplicity or multiple tax deductible charity organizations. So when you give money to some of these tax deductible charitable organizations, those payments are what we call qualifying payments. Qualifying payments. So those qualifying payments can be deducted from that assessable income. And then you arrive at your taxable income. And you calculate your income tax on that taxable income. So if some of you weren't able to follow what I said, I'll repeat this very carefully. If you take the entirety of your income from all of your sources, that's what you call the total statutory income. You don't pay income tax on that. You're entitled to make deductions for the expenses that you incurred. And then you arrive at what is called an assessable income. So you can see now the value gets narrower. And then you take that assessable income, and if you make certain payments, which are called qualifying payments, for example, payments to certain statutorily recognized charities, that assessable income is further narrowed to what is called a taxable income. And it is on that taxable income that you calculate your income. So that's where you go into that. So this depends on the law at any given day. Perhaps that 500,000 rupee tax-free zone, then the first slab is at 6%, then the second slab is at 12%, and it goes as high as 36%. So that is essentially how you calculate your income tax.
Thank you, Mr. Jayasinghe. Since you spoke about taxable income and how you calculate your taxable income and the taxes payable, another question that one may have is, for example, once you have fixed deposit in your bank account, the bank deducts what is called a withholding tax.
Right.
How do you get a credit for such withholding tax? Where do you use that withholding tax that you have been deducted in your calculation of that taxes payable?
Now, if you look at the current Inland Revenue Act regime. Now, you asked me specifically about the withholding tax that is withheld by a bank. In order to understand your question better, Roshita, and to give a more complete answer, if you don't mind, I'd like to explain the different ways in which a person pays their income tax. So if you look at it, Rushita, there are three ways by which income tax can be recovered. Three ways. And as to which method applies to you depends on the nature of your income generating activity. So let's take for example that you were doing your own business, a kind of a sole proprietorship. Let's say I'm operating a grocery store. So nobody else knows my income apart from me. So in that situation, I file my tax returns. Everybody has to file a tax return. But in my tax return, I myself declare how much money I have earned, and I myself make the calculation as to what my tax liability is. Now, I want to tell you, Rushita, this particular method of paying taxes on a self-declaration is a very, very attractive option for a person who is not very honest. This is because there might be a temptation to sort of understate your income. So maybe I made 10 million, but I say I just put it as 8 million. And to be quite frank, the Inland Revenue Department may not know that when you've declared 8 billion, that you've actually earned 10 billion. So if you are a little flexible with your honesty, I think the self-declaration system is somewhat of an attractive option. So that's one way of how taxes are recovered. That is the self-declaration, and that would only apply to a situation where you are kind of engaging in a business of your own, and only you would know how much money that you earn. The second system is a kind of an institutional system. This is what we call the APIT. Can I take a minute to explain that, Rushita? This is quite interesting. Yeah, this APIT is what was previously called the payee tax or the pay as you earn tax. So when you are an employee, that is when you have an employer. Like take as an example, take myself. I am employed by the Attorney General's Department. So I get a salary from the government. That salary is paid by the accountant of the Attorney General's Department. So the accountant, and indeed finally the government, knows how much money I make. So that accountant, he takes that sum of money and he or she knows the formula for calculating my income tax. So she would apply that tax formula and deduct my income tax at the source. So these are what we call source deductions. The income tax is deducted at the source. So what does that mean in tangible terms? When I get my salary, the income tax has already been deducted. So this is what you call the APIT. APIT stands for Advanced Personal Income Tax. So what happens is, Rushita, generally your liability to pay income tax is triggered on the last day of every quarter. So if you take the first quarter of the calendar year, you're not liable to pay income tax on the 31st of until the 31st of March. But as you know, your salaries are not paid on a quarterly basis. Salaries are generally paid on a monthly basis. So my January salary might come on the 25th of January, February salary on the 25th, and so on. So when my January salary is paid, a part of my income tax is deducted in January on 25th. A part of it is deducted on the 25th of February. 25th is generally what we call payday. And the remaining part is deducted on the 25th of March. So the entirety of my income tax liability for that first quarter has been deducted before the 31st of March, even though my liability to pay is triggered only on the 31st of March. So this is why it's called the APIT, APIT, Advanced Personal Income Tax. The income tax is deducted in advance. Advance meaning it is deducted before you're actually liable to pay. But on your more specific question, what is withholding tax? Okay, withholding tax happens in different. Withholding tax is very similar to APIT because it is also a kind of source deduction. This can happen in different contexts. So for example, if I am a independent contractor as opposed to an employee, I think this is what applies to most attorneys at law. You perform a service for your client and the client remunerates you, but you're not the employee of your client. You are in a sense an independent contractor from the perspective of the client. So in that situation, what the client does is when he pays you your fee, he deducts the withholding tax, and the same principle applies when you have a fixed deposit in a bank. You generate an interest income. The bank knows how much that interest income is. But because the bank doesn't know all your sources of income, you may have accounts in other banks, it won't know what slab you come under. So you know that the more you earn, the higher the tax rate, 6%, 12%, 18%, 24%. So what the bank does is, you have a certain sum of money, but the bank doesn't know the entirety of your income. So what they do is they withhold a notional sum of money, which is fixed. It was previously 5%. Now it's increased to 10%. So let's say if I have a particular interest income from a particular, say, government bank, when that bank pays my interest income, it deducts a 10% withholding tax. So when I'm getting paid my interest income, it is less a 10% withholding tax. But you will ask me that question. I think this is a very specific question you put to me, Rushita. But your tax liability might be more than 10%. Let's say your interest income is very, very large. It could be as high as 36. Are you getting away with just paying 10%? Are you getting away with a 10% withholding? No. So what you need to do then, Roshita, is you have to file your tax returns, indicate clearly that you're liable to pay at 36% because your income is such that you have hit that 36% slab, and you can claim a credit for the 10% which has already been withheld. So just to simplify that one more time for some of our participants who may not have understood, in the case of a Sole proprietorship, where you're doing your own business, you have no other choice than to give a self-declaration where you yourself set out how much money you earn. Temptation perhaps to understate your income, but that's up to every individual. That possibility simply doesn't work when it comes to the APIT, because your income is paid by someone else, and that someone else has no incentive to help you defraud the treasury. So that person is going to calculate the income tax correctly because that person knows your income and knows the tax formula and applies the tax formula, calculates your income tax, and deducts it at the source. So in that situation, the government gets every cent that it is entitled to recover from you. You have no opportunity to pay less than what you are statutorily required. In the case of the withholding system, you will see, Roshita, it's a mix of both. So as you, in your specific question, the bank will make a 10% withholding. That is a statutorily predetermined withholding. So that ensures that at least the government will get 10% of the tax. But then it's up to you to pay the balance, declare accurately what is your total income, and you're given 10% or credit for that withholding. So that is essentially the way taxes are recovered from citizens in practical terms.
Thank you, Mr. Jayasinghe. That was very informative. Before we move forward, I would like to remind our participants that there is a Q&A box and you all can raise your questions that we will address towards the end of this session. Mr. Jayasinghe, during your previous explanation, you spoke about self-declarations.
Yes.
That might be a very attractive option to certain citizens who might be tempted to dishonestly maybe understate their income. In such a situation, assuming there has been an understatement by the declarant, what remedies would the Inland Revenue Department have to rather assess this person for the actual income that this actual taxes that this individual or company would have to pay?
Right. Now, what would happen is, let's take a fictitious situation. Let's say I am that dishonest person. So let's say my actual income is about 10 million rupees, but nobody knows what my income is apart from me. But as you know, Roshita, you can't hide everything, because if you are doing a proper business, you have to have meticulous records. If the Inland Revenue Department feels that, hold on, we don't believe Manohara's income is as low as 5 million, I'm sure it's a lot more than 5 million, the Commissioner General of Inland Revenue has the power to summon whatever records he may think is necessary to determine my accurate income and determine my income tax liability accurately. For example, he might call for my profit and loss accounts or my audited statement of accounts or invoices or whatever documentation. And he will conduct an investigation and he will say, nope, Mr. Jayasinghe, you have in your declaration have said that you are liable to pay only 5 million. I do not accept it. I hold that your tax liability is a certain sum of money which is much higher than what you have declared. So then at that point, I, the taxpayer, am served with what is called an assessment. An assessment. What do you mean by assessment? The taxpayer, sorry, the Inland Revenue Department, a person called an assessor, has rejected my tax returns. I don't accept the fact that you only have to pay this much of taxes. I think you have to pay a sum of money that is much higher. So when he rejects my tax returns, he has to make an assessment as to how much taxes I have to actually pay. So then he makes that assessment and he notifies that assessment to me. Now, when that happens, Rushita, I have two choices. I can either accept the assessment and pay that sum of money, that is the shortfall, that is the gulf between what I declared and what the inland revenue has stated I am liable to pay. Now, if I pay that sum of money, there is no problem. But if I'm not happy to pay that sum of money, I have the right to prefer an appeal to the Commissioner General of Inland Revenue. Under the 2006 Act, you could prefer an appeal to the Commissioner General of Inland Revenue. There is a further appeal. So when you get the assessment under the hand of the assessor, and if I'm not happy with that assessment, I appeal basically to the commission, the head of department of the tax department. He will look into my appeal and he will make a determination. If I'm not happy with that determination, I have a further right of appeal to an independent statutory tribunal called the Tax Appeals Commission. And from the Tax Appeals Commission, if I'm not happy with their decision, I can prefer a further appeal to the Court of Appeal by way of what is called a case stated. So I don't want to go into all those intricate details now. That is why most of the tax cases are finally, if not settled earlier, get resolved by a judgment of the Court of Appeal, because the Court of Appeal has a special jurisdiction under Section 11A of the Tax Appeals Commission Act to dispose of these tax disputes by determining certain questions of law that have been preferred to the Court of Appeal by the Tax Appeals Commission. Anyway, those are more in the line of what is applicable to practicing tax lawyers. I don't want to go into too much detail. The current legal regime, Rashita, as you know, is a little different because they have a system of administrative review. And from there, you can go directly to the Tax Appeals Commission. I don't think I need to go into all those details. So finally, once the Court of Appeal determines your tax liability, you of course have a further constitutional right of appeal to the Supreme Court. That becomes your final tax liability.
Thank you, Mr. Jayasinghe. Taking you back to the introduction that you made. In the introduction, you informed that persons are also taxed on the sales you make, and you made a reference to the VAT tax. Would you be able to briefly explain to us what is this concept of VAT? How does it work, and who pays VAT?
Okay. The value-added tax regime is very different from income tax. So as I told you at the beginning of this program, either the government taxes you on the money that you earn, or it taxes you on the money that you spend. So the money that you spend, the taxing is what is called a sales tax, and the current incarnation of sales tax is called the value-added tax regime. Previously, it was called the goods and services tax. Now I'm going to explain something interesting, that when you the liability to remit VAT, to remit it at the inland revenue, remit it to the inland revenue department, that liability falls on the supplier or the vendor. So for example, I buy a loaf of bread from the supermarket. The responsibility of remitting the tax falls on the supermarket or the vendor. But keep in mind, the liability to pay the tax is on me. The supermarket merely acts as a collecting agent on behalf of the tax department in order to collect the tax from me. So let's give an illustration, Rushita. Let's say in a world without sales taxes, the price of bread might be 100 rupees. So I go to the supermarket, I tender 100 rupees as the price for the bread. But let's say the government decides to introduce a 15% VAT. Then the supermarket will, in all likelihood, add that 15 rupees to its price. And that 15% tax or the 15 rupee tax is separately invoiced. That is why when you look at your invoice, it will say price 100 rupees, 15% VAT. So now all of a sudden the sum that I'm tendering to the inland the supermarket is 115 rupees. But and keep in mind that 100 of that 115 rupees, the supermarket gets to keep only 100 rupees. The 15 rupees has to be remitted by the supermarket to the Inland Revenue Department. But keep in mind, Rushita, sometimes we might get this confused, that tax, though physically paid by the supermarket to the Inland Revenue Department, is not the taxes of the supermarket, it's my tax. It's the tax which was recovered from me by the supermarket. That is how the VAT system works. That is how a sales tax system works. If I can just continue this point, Rushita, with your permission, and I think this is also very relevant when it comes to the VAT system.
Yes, Mr. Jas.
Always remember that value-added tax depends on what we call a chain of supply. Keep in mind that if you take my mobile phone over here, that wasn't made by one person. I may have purchased it from one shop, but the production of that phone involves a chain of supply. So I'll give a better example. Let's say you buy a loaf of bread. Now it starts with the farmer. The farmer cultivates the wheat and the farmer sells the wheat to the miller. So then the miller pays VAT to the farmer. The farmer acts as the collecting agent for the miller. Then the miller takes the wheat and he grinds the wheat into flour. So what does he do? He adds value. He adds value to the wheat. And then he sells the wheat to the baker. Then he recovers a tax from the baker. So now the miller acts as the collecting agent for the collecting agent who recovers the tax from the baker. Then he must take that tax he recovered from the baker and remit it to the Inland Revenue Department. But one caveat here. Can you remember that miller who sold the flour to the baker and recovered from the baker a certain amount of VAT? But can you remember how that same miller paid a certain amount of tax to the farmer? When that miller bought the wheat from the farmer, he paid the farmer a certain tax. Similarly, when the miller sells the flour to the baker, he recovers from the baker a certain amount of tax. So when the miller pays or remits the VAT that he recovered from the baker, he is given credit for the tax that he has already paid to the miller. This is the concept of VAT refunds. Just as I sell something to you, Rushita, I recover the VAT that you are liable to pay. And I have to take that money and remit it to the Inland Revenue Department. But in order to make the thing which I'm selling to you, I may have had to buy something, some raw material for which I have already paid VAT. So I can get credit for that VAT I have already paid, and that can come in the form of a VAT refund. So always remember, in the case of the VAT, there is a chain of supply where you recover VAT or you collect the VAT from the person you are selling it to, and you obtain a credit for the VAT that you have already paid to the person who precedes you in the chain. So that's a little complex, but this is a very, very meticulous system that ensures a efficient recovery of taxes by the state.
Thank you, Mr. Jayasinghe. So if I understood it correctly, in the case of the miller, is the miller required to set off what he pays when he purchases, as opposed to what he collects when he sells, and remit
Yes.
to the Inland Revenue Department only that balance difference between the two amounts?
That is exactly correct. And if any one of you are at home, not now and not on a Friday night, I know you have more exciting things to do on a Friday night. Just take a hypothetical example and see how, let's say, if you say that the price of the wheat which the farmer sells to the miller is 100 rupees, and put a 10 rupee tax on that, and then let's say the miller turns the wheat into flour, and then he sells that to the baker at 200 rupees, and then let's say the baker takes the flour and turns it to bread and sells it to the consumer at 400 rupees. If you do this as a chain, and if you offset the taxes that you have paid from the taxes that you have recovered, and calculate the total sum of money that is actually remitted to the Inland Revenue Department. So if you take every entity in the chain and calculate the net sum of money that they have actually remitted to the Inland Revenue Department, you will quite dramatically see that that sum is equal to the tax that was paid by the consumer. So this is actually quite fascinating, because finally, though there is a chain of supply, farmer to the miller, miller to the baker, and baker to the consumer, the entirety of the tax, though recovered in stages, is actually borne by the consumer. That's why VAT is called a consumption tax, a sales tax.
Thank you, Mr. Jayasinghe. Let me once again remind our participants that you all are free to raise your questions in the Q&A box, which Mr. Jayasinghe will address towards the end of this session. Mr. Jayasinghe, in explaining about what VAT is, you gave an example of a supermarket. In the supermarket example, you mentioned that the person who goes and purchases something from the supermarket is the person who's actually liable to pay what is called as VAT, and that the supermarket is a collecting agent.
That's right.
Let us assume, for example, the supermarket does collect this VAT from this customer, but fails to remit it to the Inland Revenue Department.
Yes.
In a scenario such as that, what happens?
Yes. Then in that situation, the tax defaulter is the supermarket. Look, try to understand, everybody, why we have a system like this. Because if there is a 15% tax on bread, you can't expect me and every person who buys a loaf of bread, every time they buy a loaf of bread, to do a beeline past the Inland Revenue Department and pay that 15% tax. That's an unworkable system. But what you can do is impose the liability of remitting the tax to that common vendor, which is the supermarket. So the complete liability of remitting the tax falls on the supermarket. So what the Inland Revenue does then is it goes to the supermarket and calls for its records and says, look, you've sold 1,000 loaves of bread, 15 rupees tax on each loaf, then you need to pay me 15,000 rupees VAT based on your record. So what the supermarket will do is it makes its own declaration, and if the declaration is accepted, there is no problem. So this is why in VAT, the invoicing system is very important. You have to clearly show that when you recovered 115 rupees from your consumer, that 100 rupees is the price of the bread and 15 rupees is the tax. So then the Inland Revenue will recover that 15 rupees from you. So in the event that keep in mind, Rushita, the supermarket is liable to pay that VAT regardless of whether it has recovered it from the consumer or not. Otherwise, every supermarket will start saying, look, we can't pay that VAT because the customer didn't pay us the VAT. So that onerous obligation is cast on that collecting agent. So if the supermarket doesn't remit the correct amount of taxes, it would be the supermarket that would be treated as the tax defaulter, even though the liability to pay the tax is on the consumer.
Thank you. Thank you, Mr. Jayasinghe. Similar to the income tax regime that we looked at earlier, even in the VAT regime, is there a procedure where assessments are raised, or is
Yes.
there a separate procedure in which the Inland Revenue can recover this VAT from the?
No, the procedure is essentially the same, Rushita. If if the supermarket defaults on paying the taxes, or if they make a false declaration of their tax liability, then an assessment can be served on the supermarket. And if the supermarket, in our example, the supermarket is unhappy by the assessment, they can appeal to the Commissioner General, and there is a system of administrative review culminating in the Tax Appeals Commission, finally ending up in the Court of Appeal. So that's how the system works. The other interesting point that I wanted to say is, Roshita, when it comes to taxes, this sort of goes back to your original question that taxes can be something very controversial, and it can have a lot of both political and policy related controversies. Now, I just want to say this just for the benefit of some of our viewers who might be interested in the policy behind taxes. There is one school of thought that governments should be entitled to impose a fair amount of taxes on its citizens, because that is the only way that the treasury gets nourished with income. And with that money, the government can perform the multiple services such as building roads, telecommunication facilities, hospitals, free education. All of these have to be paid by taxes. So there is a school of thought in certain countries, including Scandinavian countries, that taxes tend to be quite high. But the social benefits are also very good, because the standard of living in those countries are very high. But there is a different school of thought saying that no, high taxes are inimical to the welfare of a society. This is the so-called American capitalist way of thinking. There the argument goes like this. If you impose high taxes on people, that disincentivizes entrepreneurship. You see, if I want to do a business, I'm doing the business to make a profit. I'm not doing it as an act of philanthropy. So I want to make a profit and I want to make maximum profit. But if I slave away and work hard, and at the end of the day, if I have to pay 40% of my earnings to the government, I might think I just might not want to do it. But there is a school of thought that if you reduce taxes, this would encourage entrepreneurship. And then as a result, a person who had that entrepreneurial drive is now motivated to pursue a business he might otherwise not have done. He might now put up a factory. And when he puts up a factory, what else do you need to make the factory operational? He needs workers. So then he creates jobs. And what if that commodity, there is a surplus? He might be able to export it if it's of a high quality. And then that generates foreign currency. So there is an alternative school of thought that high taxes are inimical to a robust economy, because when you impose high taxes, people don't like to engage in business. And when people don't engage in business, the production is less, which means that the gross domestic product or the GDP is less. And that's generally an indication of a bad economy. So I know that different governments in Sri Lanka have had different policies, and it's up to each individual to decide as to what they consider to be the best policy. But I just want all of our viewers and participants to understand that there are two aspects to taxation. That on the one hand, yes, taxation is important in order uh, to generate money for the welfare state, but also imposing heavy taxes tends to disincentivize business. I suppose to some extent the compromise that has been reached is these so-called special zones like these board of investment, where special incentives are given to businesses, particularly businesses which can show that they can generate employment, that they can bring in foreign currency, and which can in general contribute to the development of the economy.
Thank you, Mr. Jayasinghe. Just going back to one of the questions that were raised earlier,
Yes.
you mentioned to our attendees about the self-declaration mechanism of paying taxes. Now, assuming one feels that no, I'm earning a particular income, but why should I go and file a self-assessment at the Inland Revenue Department? Can't I just wait without filing and maybe perhaps not pay taxes at all? Can a person do that? If a person does that, what are the consequences of doing so?
Okay, so you can do that. And there are a lot of people who do that. And they do it successfully. But eventually the law will catch up with you. Because if in the end, Roshita, we make money to spend money, there isn't much of a point in making money if you are not going to spend it. So if you are not a registered taxpayer and suddenly there is a suggestion that you're leading a very extravagant life, that's when the Inland Revenue Department gets suspicious. Then they send their what you call their sort of their squads, flying squads, and they examine your business and they check whether you've been paying your taxes. And then if they find that you haven't paid taxes, you not only have to pay the taxes which you have neglected to pay, you may have to pay a very, very heavy penalty. So, and I think this the point that you raised now, Roshita, is another a good cue for me to very briefly comment upon another aspect of taxes. These are what are called tax amnesties. What are tax amnesties? Tax amnesties, Rushita, are very, very controversial because some people say, hey, that guy has been doing a business for 10 years and suddenly, and he's never been paying taxes, and then suddenly I've been paying taxes diligently, and you go and give this guy a tax amnesty. That's not fair. Recover from him the entirety of the taxes he's been liable to pay. So that was, I think, the thinking that certain people had that tax amnesties are inherently unfair. But Rushita, the reality is this. Tax amnesties, as counterintuitive as it sounds, is actually a very, very effective tool that leads to the recovery of more taxes. Because if I'm doing that business for 5, 10 years, not paying taxes, then all of a sudden the government declares a tax amnesty. Then what happens is the government, in terms of the tax amnesty, says, look, I know there are people out there who are making a lot of money, who are not paying taxes, but please come forward and pay a kind of a nominal sum as taxes, and we will forgive and forget your entire. That's what the word amnesty means. Amnesty is related to the word amnesia. Amnesia means to forget. We'll forget your sins of the past, and from now on we will recover from you a kind of a nominal tax for all the taxes you haven't paid in the past, but from this day on you are now in the tax net. So from that day onwards I will have to pay taxes. And there are many people who actually respond to the tax amnesty because they realize they've gotten away with not paying taxes for so many years. Eventually, they are going to get caught. And on the day that they get caught, their liability of unrecovered taxes is very, very high. So many people, businessmen, say, look, I've enjoyed breaking the law for so many years. Maybe now I'll take advantage of this amnesty and accept the amnesty, pay nominal taxes, and from this day onwards, I will pay the accurate amount of taxes.
Understood. Ms. Jaising, if another question that one may have is, what
Yeah.
if there, for example, there could be an admitted liability or an assessed liability that has gone unchallenged, or an assessed liability that maybe finally the Supreme Court has deliberated on? If there is such a liability, but the taxpayer is saying, look here, I can't pay. I don't want to pay. Although I have admitted it, although I have been assessed, although maybe the Supreme Court has decided, I say I can't pay.
Yes.
In such a situation, is there a mechanism in which the Indian Revenue Department can recover taxes admitted taxes or assessed taxes or taxes decided by court, can the Inland Revenue Department, or is there a mechanism that they can recover such monies from this individual who is refusing to pay or evading to pay?
Okay, let's say my tax liability has become final and conclusive, which means either all my appeals against the tax liability declared by the IRD have been exhausted, or a case where I had an opportunity to appeal and I didn't appeal. So the Inland Revenue Department tells me I have to pay 10 million rupees more in taxes than what I have declared. In that situation, how does and I said, well, I'm sorry, I'm not paying that money because I don't have that money. Then what happens, Rushita? There are three ways that the Inland Revenue Department can physically recover that tax from me. The first way is that they employ a person called a fiscal. The fiscal knocks on my door and says, look, Mr. Jayasinghe, you need to pay 10 million rupees more taxes. Since you haven't volunteered to pay it, even though all your appeals have been exhausted, I'm now going to take all your, and he's empowered by law to do this, seize all your movable property. It could be cash in hand, it could be jewelry, it could be a motor vehicle. And they can recover all of that or seize all of that and sell all of that and recover the tax in default. Now, Roshita, as you might understand, that's not a very efficient way to recover taxes for people whose tax default runs into sometimes billions of rupees. Then what you can do is you can recover the tax in default by seizing immovable property. So if that person owns large areas of land, let's say a 40-acre estate or something, then the Commissioner General of Inland Revenue can file a certificate in the district court. And if the district judge is satisfied that the material in the certificate is in order, the district judge can direct that certain properties be seized and sold to recover the tax in default. But to be very frank with you, Rushita, this is not the most efficient mode of recovery. Because when people are defaulting their liabilities to the state, all of a sudden their properties also disappear. They might try to sort of hide their property. They might alienate their property to a sibling or a cousin or somebody, so that on record they don't appear to own any property which can be seized and sold. That's where the Inland Revenue Department, the Commission General, follows what is generally thought to be the last resort, but it has now become the first and only resort, because this is the most effective way for recovering taxes. What is that? You file a certificate in the magistrate's court. And if the magistrate is satisfied that all of the contents of the certificate is accurate, he will then order that money to be recovered as a fine. A fine, and the procedure that is to be followed in recovering that fine is the procedure laid down in the Criminal Procedure Code. So if you don't pay that fine, the fine meaning the tax in default which is recovered as a fine, you go to jail. And it's quite surprising how many tax defaulters who claimed that they didn't have this money to pay they manage to cough up a large part of that money. So that is one of the most effective tools for recovery of taxes.
Thank you, Mr. Jaisingh, for that explanation. We will now move into the Q&A session.
Yes.
Yes. So there is a question by one individual, which reads as follows. APIT deducted on monthly salary, is it mandatory? Why the taxpayer could not pay quarterly with SAP without deducting on the monthly salary? Please advise.
Okay, thank you, Derek. I do appreciate that question. Can I tell you a little interesting anecdote? And it's not an anecdote, it's a real story. It's a real story which we all experienced. We all recall the catastrophic economic crisis that happened a few years ago. So now there are different explanations as to what triggered this economic crisis. It's widely believed that the economic crisis was triggered, and I think there is a Supreme Court judgment that confirms this, that the economic crisis was triggered by a very, very lax and imprudent taxation policy. Taxes were far too low. Well, that's one thing. But it's one thing even if the taxes are relatively low, if taxes are recovered. I know this as a fact, Rushita, because when I was assisting my good friend Mr. Vigneswaran in a special determination on the Inland Revenue Bill, and we had access to certain data from the Inland Revenue Department, and there was a period, a 1 or 2 period, where the revenue generated by the treasury was appallingly low. One of the reasons was this. The APIT which Mr. Jayakumar speaks about, at that time, and I think this is your question, Derek, was not mandatory. It was optional. I'm Manohara Jayasinghe State Council. I get a fixed salary. That salary is known to me and it's known to my accountant. And I'm given the option to direct the accountant to deduct the salary at source. Or I have the option of no, I'll just declare and pay. What did I tell you, Rushita, was the advantage of declaring and paying as opposed to deducting at the source? You can understate. You'd be quite surprised as to how few people opted for the APIT deduction. The overwhelming majority of people did not opt for the APIT deduction. They say that we'll declare and pay. So I don't have any proof as to whether people were being dishonest, but chances are people who opted to declare and pay as opposed to have it deducted at the source, at least some of them may have significantly underdeclared their income. So this is why, Rushita, the government in 2022 realized that APIT has to be mandatory. At least where you are institutionally bound, at least where you have an employer. You can't impose APIT on the person who owns a grocery store where nobody else knows his income. But for someone like me, who has a fixed salary which is paid by a government department, APIT is mandatory. So I know Mr. Jayakumar's question was as to whether it's mandatory or not. It is mandatory. And I think the government specifically amended the law to make it mandatory because I think there was a sense that if you don't make it mandatory, most people would not opt for it, and there is always then that fear that they may declare a lower income than what they actually make.
Thank you, Mr. Jayasinghe. There appears to be several questions on this area of e-money.
Yes.
Certain attendees appear to be questioning on whether, for example, one question is, nowadays most of the young people earn e-money from online trading.
Yes.
What about their earnings?
So in the end, the answer to that question about e-money is where the money is sort of not physically given to you, but I believe it's sort of uh, uh, sort of remitted to your account, and you can sort of use that value for your purchases. So I think e-money has a very broad definition. I don't know whether e-money also constitutes cryptocurrency, but on the question of e-money, in the end, it's an income. So if I engage in some kind of activity and somebody pays me as a kind of a money remittance to a digital wallet, that's still an income. I have to declare it. So I know it's a complex question of law, and I don't profess to be very familiar with it, but the basic principle remains true. If you're generating money, then you're making an income. Whether you get the money physically to your hand, or whether the money is remitted directly to your bank, or the value of the money is placed in some kind of digital wallet, that's still an income. And you have to declare it, and you have to pay income tax on it.
Thank you, Mr. Jayasinghe. This next question, you answered it also during the session, but however, I will pose it once again to you. The question reads, what measures can be taken against those who cheat or do not pay income tax? Question mark, such as fines or any kind of punishment.
Yes, so as I explained, that there are two disincentives. So there are two aspects to this. If you are liable to pay income tax and that liability has been determined, and where you are no longer challenging that determination, then if you don't pay that money, then the simple, crude, blunt answer is there is a very good chance that you will go to jail. So once your tax has been determined to be 1 million rupees or whatever that amount, you are strongly advised to pay that sum of money, because otherwise you will be hauled up before a magistrate and the money will be recovered as a fine. And if you don't pay the fine, you risk imprisonment until that sum of money is paid. But the other aspect I also want to talk about is, you might be tempted to understate your income or falsely calculate it by claiming exemptions which you're not entitled to, and so on. So there is a risk in doing that, because if you get caught, they might impose a penalty. So in addition to paying the shortfall of the taxes which you try to evade, you may also have to pay a very, very steep penalty. So I know there is a human tendency to err on the side of paying less than paying more, because if I am doubtful as to whether I should pay a sum of money to the government, I would probably not pay that money. But if the government asks me to pay it, then I'll pay it. So that's fine. But in many of the cases of people who are tax defaulters are people who actively try to cheat the state. They know that they are liable to pay. They know that they are obligated to pay, but they purposefully understate their liability. And yes, there are consequences.
Thank you, Mr. Jayasinghe. The next question, I believe, relates to disallowance of an input PAT claim. However, I'll read the question as it is posted.
Yeah.
It reads, why IRD reject my input PAT, saying VAT has not been remitted to the IRD by the collector? Since I have valid VAT invoice, is it legal? If so, what is the provision they use, and not what action can take?
Yeah, now Roshita, that is a question that is a little complex because it's very difficult for me to answer it without context. So I don't want to give a specific legal answer to a question like that. But just to remind the person, and I hope this is helpful. I'm sorry if it's not. But let me read the question. Since I am entitled to a VAT refund, however, during a recent audit, the Inland Revenue stated that my SVAT schedule and VAT do not tally, and therefore they cannot proceed with the VAT refund. Asked me to sign to disallow the VAT refund. So that is something very specific to the person posing the question. But always remember, the general principle is that you are entitled to a refund if you have already, remember that chain of supply I was talking about. So just as much, so initially when I buy a commodity, I have to pay taxes to my vendor who acts as my collecting agent. So I pay 100 rupees to my collecting agent, who is the vendor who sold me something. Then I take that commodity, enhance the value, and sell it to somebody else. Then that person, I recover from him 200 rupees. So that is the 200 rupees tax which my buyer or purchaser is liable to pay. But when I pay that 200 rupees, I'm entitled to a credit for the 100 rupees I have already paid. And that credit is given. I'm not sure whether the credit can be deducted at the point of payment or whether it must always come in the form of a refund. But in that situation, you would be entitled to that credit. So exactly as to why this particular individual was not given the refund, I'm not quite sure as to how to explain that.
Thank you, Mr. Jayasinghe. We have now come to the end of our session. I would like to thank you for taking time from your valuable personal schedules to attend this webinar and explain to us the basics of the law of taxation, and to also simplify it as much as you did, which simplifies such a complicated area as much as you did. So I thank you, Mr. Jayasinghe, for gracing us with your presence today. And I now call upon Isuri to formally end this session.
Thank you, Rushita. Thank you, Isuri.
Thank you, Mr. Rodrigo. Thank you, Mr. Jayasinghe. So this brings us to the end of the 15th webinar of the series on basics of law, titled Law of Taxation. I thank our esteemed panelist, Deputy Solicitor General, Mr. Manohara Jayasinghe, and our moderator, Mr. Rushita Rodrigo, Attorney at Law, for the fruitful and educational discussion, and for dedicating your time to be here with us and sharing your insights. I thank the BSR Webinars and Legal Symposiums Committee for their dedication and hard work in organizing this insightful webinar. I also extend my thanks to all the participants who have joined in for this session today. Thank you, and I hope you have a very good night.
Thank you, Isuri. Good night. Thank you. Happy weekend.
Thank you, Isuri.